Meet Gary from Ohio. Gary is 68 years old. He retired 2 years ago with a solid plan. He put the core of his retirement portfolio into SCHD, the Schwab U.S. Dividend Equity ETF. His neighbors thought he was playing it too safe. Why hold dividend stocks, they said, when AI and tech are going to the moon? Well, right now, in 2026, Gary's portfolio is up about 12% year-to-date. His neighbors down 3 to 5%, and the people who bet everything on QQQ, the NASDAQ tech ETF that Wall Street kept calling a sure thing, they are down nearly 5% too. That gap is almost 16 percentage points. This is not a lucky week or a lucky month. This is the widest dividend-over-growth outperformance gap since 2022, and there are very specific reasons it is happening. We are going to cover every one of them today. By the end of this video, you will understand exactly why dividend stocks are winning. You will see the 3 forces driving this gap. You will learn what SCHD just did to upgrade its own portfolio. And I'm going to show you a tax angle that almost nobody is talking about, one that could quietly cost retirees thousands of dollars a year if they're not paying attention. Quick note, I'm not a financial advisor or a government employee. Everything in this video is for educational purposes only. For your specific situation, always talk with a qualified professional. Now, let me start with the thing most people get completely wrong about dividend investing. Here's the myth, and the 50-year truth that kills it. Here's the myth. Dividend stocks are the slow, boring, safe choice. If you want real growth, if you actually want to build wealth, you buy growth stocks. Dividend investors are people who gave up on the upside. Well, here's the truth. Over 51 years of data, dividend growers delivered the highest returns and the lowest volatility of any category of stocks in the entire market. Ned Davis research studied every category of S&P 500 stocks from 1973 to 2024, 51 years of data, and here is what they found. Companies that paid and grew their dividends delivered an average annual return of 10.24%. Companies that paid no dividends at all, your growth stocks, your high-flying tech names, delivered just 4.31% per year, less than half the return, with more volatility on top of it. $100 invested in 1973 in companies that paid and grew their dividends became $14,118. The same $100 in non-payers became just $843. That's not a typo. And the companies that cut or eliminated their dividends averaged negative returns across those 51 years. They didn't just underperform, they destroyed wealth. Now let me put real faces on those numbers. Meet Barbara and her brother-in-law, Ray. Both 67, both retired last year with $400,000 each. Barbara built her retirement around SCHD. Ray built his around a growth-heavy NASDAQ fund. In 2025, Ray actually won the year. His portfolio climbed to $483,000. He was very happy to mention it at Christmas dinner. Then 2026 arrived. By early April, Ray's portfolio had fallen to roughly $459,000. But here's the real problem. Ray needs $18,000 a year to cover his living expenses. His growth fund pays almost no dividends, about 0.5% yield. That's roughly $2,300 in annual income. To cover the rest, he has to sell shares every quarter into a declining market. Those shares are gone forever. They'll never recover with him. Barbara, her SCHD is up about 12%. Her portfolio sits at around $469,000, and she's collected roughly $14,000 in dividends over the past 15 months without selling one share. She kept every share. They're still compounding, still working for her. Same starting amount, same time frame, completely different outcome. And that's not luck. That's the design. So, you now understand the 51-year story. But what specifically blew this gap open so fast in 2026? There are three reasons, and one of them is something most people have never heard explained. Three reasons dividend stocks are winning right now. Three things came together in early 2026 to create this outperformance gap. First, the hidden tech problem inside the S&P 500. Most people do not realize how much technology exposure they own when they buy a standard S&P 500 index fund. The S&P 500 puts about 32% of your money in technology companies. Add another 11% for communication services, companies like Meta and Alphabet, and nearly 43 cents of every dollar is in high-growth, high-valuation tech. SCHD holds about 9% in technology and 14% total, including communications. That's a 30 percentage point difference in tech exposure. When tariff fears hit and big tech earnings disappointed, the S&P 500 took the full impact. Consumer discretionary, Amazon, Tesla, dropped nearly 11% in the first quarter alone. SCHD investors were watching from a completely different position. Second, the oil shock. Tensions in early 2026 pushed oil prices from $71 per barrel to $120, a massive, rapid move. Energy is SCHD's largest sector, roughly 21% of the fund. While tech was falling, SCHD's energy holdings were surging. The fund was positioned in exactly the right place at exactly the right time. Third, recession fears and the flight to quality. Goldman Sachs raised recession probability to 30%. Consumer confidence hit some of its lowest readings in years. When investors get scared, money moves toward companies generating real cash right now, not companies promising profits 5 years out. The VIX Fear Index averaged 25 in March, against a long-term average of about 19. That level of fear consistently pushes capital into dividend-paying businesses with stable, predictable earnings. Here's the critical historical parallel. This is not the first time this movie is played. In 2022, the exact same playbook. Oil shock, tech sell-off, recession fears. That year, SCHD fell just 3%. The S&P 500 fell 18%. QQQ collapsed by 33%. The gap in 2022 was almost identical to what we're seeing in 2026. Take a look at these numbers. SCHD is up 12.3% just did to its portfolio, and why it matters. Every March, SCHD goes through its annual reconstitution, a rules-based review of every holding in the fund. The fund scores every stock against 4 financial criteria: free cash flow relative to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Stocks that no longer qualify get removed. Stronger candidates take their place. This March, SCHD added 25 new stocks and removed 22. The stocks it removed had one thing in common. Their share prices had risen so much that their dividend yields had compressed below what the index requires. Valero was up 80%, Halliburton up 47%. Great runs, but the rules kicked them out automatically near the top. That's not a flaw. That's the quality screen doing exactly what it was designed to do. The new additions tell the other half of the story. Incoming stocks averaged 63% 5-year dividend growth rate, compared to 37% for those removed. The fund is systematically upgrading its dividend quality every single year. Two of the most significant additions are United Health Group and Abbott Laboratories, healthcare companies with strong balance sheets and long records of consistent dividend growth. Healthcare now represents 16% of SCHD. That's a meaningful shift, heading into an environment where healthcare spending remains resilient regardless of what the broader market is doing. SCHD added 25 stocks and removed 22. Additions averaged 63% 5-year dividend growth versus 37% for removals. Key additions include United Health, Abbott, Procter & Gamble, and Qualcomm. Key removals are Valero and Halliburton. Both had appreciated significantly, compressing their yields below the qualifying threshold. Before I show you the tax side of this story, drop a comment right now. Are you already holding SCHD in your retirement portfolio, or are you still on the fence? I read every single comment, and I genuinely want to know where you stand. Everything I've shown you so far is the good news for dividend investors in 2026. But there's one piece of this story that almost nobody is connecting to SCHD's outperformance, and it's the piece that can quietly cost retirees thousands of dollars a year if they're not paying attention. The tax side of dividend outperformance, what most retirees get wrong. When SCHD pays you dividends, the IRS considers those qualified dividends, taxed at 0, 15, or 20% depending on your total income. A married couple with taxable income below $98,900 pays 0 federal tax on those dividends. 0. That's genuinely favorable treatment. But in retirement, dividend income doesn't exist by itself. It stacks on top of your Social Security, your pension, and your IRA withdrawals. And that stacking can trigger 3 tax risks that quietly reduce what you actually keep. Risk 1. IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a Medicare surcharge that kicks in when your income crosses specific thresholds. For 2026, a single retiree crossing $109,000 in modified adjusted gross income faces $974 per year in extra Medicare Part B premiums per person. A married couple crossing $218,000 faces close to $2,000 in additional premiums per year combined. Qualified dividend income in a taxable account counts fully toward that income calculation. It's not invisible to Medicare. And these brackets are cliff structures. Cross the line by $1 and you owe the full surcharge for the entire year. Take George and Sandra from Tennessee, both 68. They collect $45,000 in combined Social Security. George has a small pension of $20,000. They hold SCHD in a taxable account, generating $15,000 in dividends annually. Total income, $80,000. They're fine right now. But if their dividends grow, which is the entire point of this strategy, or if they add a modest IRA withdrawal to cover a home repair, they could step over that IRMAA line without realizing it, and it will cost them nearly $900 per person in higher Medicare premiums for the entire following year. Risk 2. The Social Security tax torpedo. Every dollar of dividend income you earn raises something called your provisional income. When provisional income exceeds $44,000 for a married couple, up to 85% of your Social Security benefits become taxable as ordinary income. The dividend income itself may be taxed at 0 or 15% as qualified income, but it is simultaneously pulling more of your Social Security into the taxable column. That creates a hidden effective tax rate far higher than most retirees expect to pay. Risk 3. The account placement mistake. This is the most common error I see. When SCHD sits inside a traditional IRA, the qualified dividend tax advantage disappears completely. Every distribution from a traditional IRA is taxed as ordinary income at your full marginal rate. Those dividends that would have been taxed at 0 to 15% in a taxable account now come out at 22, 24, or higher every year for the length of your retirement. For most retirees safely below the IRMAA threshold, a taxable brokerage account preserves the qualified dividend treatment and provides a step-up in cost basis for your heirs. For retirees near the IRMAA line, a Roth IRA is the strongest option. Dividends grow completely tax-free. Roth withdrawals do not count towards your modified adjusted gross income at all, and there are no required minimum distributions pushing additional money into your taxable income. The dividend strategy is working in 2026. Make sure the tax structure around it is working just as hard. Dividend to your taxable income. The dividend strategy is working in 2026. Make sure the tax structure around it is working just as hard. Dividend investing has had its critics over the past few years. People called it boring, too slow, a strategy for investors who gave up on real returns. 2026 is answering that argument with live, real-time data. SCHD is up 12%, while the S&P 500 is down 3.5%. The gap is nearly 16 percentage points.
And the strategy that has compounded wealth for more than 50 years is doing exactly what it was built to do: generating income, protecting principal, and keeping retirees out of the forced selling trap that is damaging growth portfolios right now. Here is the one thing I want you to carry away from everything we covered today. Growth stocks promise to pay you someday. Dividend stocks pay you today and raise it every year. If someone you know is watching their growth portfolio drop right now and wondering what to do, share this video with them. It might give them a very different way of thinking about where to put their money. One more comment question before you go. What percentage of your retirement portfolio is currently in dividend ETFs like SCHD? Give me a number right in the comments. I read every single one. If you are building retirement income and want to stay ahead of market moves like this one, subscribe to this channel. I cover everything that protects your income in retirement, from the investments to the taxes to the Medicare traps most people never see coming. And in my next video, I'm going to show you a tax trap hiding inside of one of the most popular income ETFs right now, one that thousands of retirees are walking into without realizing it. You do not want to miss that one.